Tesla stock is currently trading at $449.06 as of the market close on Friday, January 23, 2026. This represents a minor intraday slide of about 0.07% from the previous session, though it masks a much more volatile week where we saw the price swing between a low of $444.04 and a high of $452.43. While most investors are looking at these daily fluctuations as noise, the reality is that the tape is telling a very specific story about institutional positioning. Right now, the expectation among many retail traders using the Robinhood app or checking their SoFi Invest accounts is that Tesla is simply consolidating before its next big leg up. The common narrative is that the worst of the delivery declines are behind us and that the company's pivot to AI and energy will act as an immediate floor for the price. However, the reality hidden in the volume data and the recent movement on the Interactive Brokers platform suggests something more complex. We are seeing a massive tug-of-war between passive index buying and active institutional distribution. While the stock has managed to claw back some ground from its mid-January lows, the overhead resistance near the $460 level is proving to be a formidable barrier that the bulls haven't quite figured out how to crack yet. If you look at the recent action on the Fidelity trading platform, you'll notice that every time we get a spike in Tesla's stock price, it is met with a surge in sell-side volume. This isn't just retail taking profits, it is a systematic rebalancing by larger funds that are wary of the upcoming earnings report on January 28th. The expectation is a relief rally because the bar has been set so low, but the reality is that Tesla's operating margins have shrunk to roughly 5.8%, down from over 10.8% just a year ago. This is a massive shift in the fundamental profile of the company. It's no longer the high-margin, untouchable leader of the EV space. It's now a company fighting a grueling war of attrition, especially in China, where BYD has effectively taken the crown as the world's largest electric vehicle producer. Many investors using online investing tools are still anchored to the 2021-2022 versions of Tesla, but the 2026 version is a company that has seen two consecutive delivery declines. In 2025, deliveries fell nearly 9% to about 1.64 million vehicles. That is a reality that completely shatters the expectation of 50% compound annual growth that was the gospel of the Tesla bull case for nearly half a decade. What makes the current setup so fascinating is that despite these weakening fundamentals, the stock hasn't collapsed. In fact, it's holding up better than many expected. This creates a curiosity loop. Why is the market rewarding a company with falling sales and shrinking margins? Part of the answer lies in the Fidelity and Schwab Intelligent Portfolios effect, where the massive weight of Tesla in major ETFs and indices creates a level of forced buying that provides a safety net. But the deeper reason is the shift in identity. The market is increasingly pricing Tesla stock not as a car company, but a massive AI and energy play. The energy segment deployed over 14 gigawatt-hours of storage in the last quarter of 2025 alone. This is the hidden reality that is starting to exceed the expectations of those who only track car registrations. When you look at Fidelity ETFs or Fidelity mutual funds that focus on the energy transition, Tesla is often the cornerstone, not because of the Model 3, but because of the Megapack. However, we have to talk about the tension in the room. The expectation is that the robotaxi rollout will be the next big thing that saves the valuation. But if you spend any time on investing sites or looking at professional investment help forums, you'll see that the timeline for true Level 4 autonomy is still a moving target. Tesla claims their FSD V14 has reached a quasi-Level 4 threshold, but in reality, only about 12% of their customer base has actually subscribed to the service. This low attach rate is a significant challenge to the narrative that software will suddenly replace lost hardware margins. Investors using self-investing strategies through Fidelity Brokerage or Robinhood Investments need to be very careful here. If the upcoming earnings guidance doesn't show a clear path to margin stabilization, the story might not be enough to hold the stock at these levels. The disconnect between the $450 price point and the sub-6% operating margin is one of the widest gaps in the entire tech sector right now. Comment below how many shares of Tesla stock you currently hold and whether you plan to buy more before the earnings announcement on the 28th. To understand where we are going, we have to look at how we got here. Tesla's business model was built on the idea of being the first and only viable option for premium EVs. For years, this worked perfectly. The Model 3 and Model Y became the global standards, and the company enjoyed a massive cost advantage. They pioneered the gigapress and simplified manufacturing in ways that made legacy auto look ancient. But as we move through early 2026, that reality has shifted. The competition isn't just coming, it's here, it's scaled, and in some cases, it's faster. In Europe, Tesla's registrations fell nearly 40% in the latter half of 2025, while Chinese brands grew by triple digits. This isn't just a Tesla problem, it's a structural change in the global market. Government incentives that once fueled the fire have been scaled back or eliminated in the US and Europe, leaving a vacuum that is being filled by lower-priced, more diversified brands. This brings us to the individual investor's dilemma. If you are using Fidelity Wealth Management or a SoFi active investing account, you're likely weighing the Musk premium against these cold, hard numbers. The approved $1 trillion compensation plan for Elon Musk increased his control, but it also increased the scrutiny of his time and focus. The reality is that Tesla's aging product lineup, with the Model 3 now in its 8th year of production, is struggling to excite a market that is increasingly looking for the next thing. The Cybertruck has been a logistical triumph, but hasn't yet moved the needle on total volume in the way the Model Y did. This creates a situation where the expectation of a product refresh cycle is doing a lot of heavy lifting for the price point. If those refreshes don't hit the market with the same impact as their predecessors, the reality of being a mature car company will start to set in, which usually carries a much lower PE ratio than the 300x trailing earnings we see today. Looking forward, the catalysts for Tesla stock are almost entirely tied to its ability to prove it is a robotics firm. The focus in early 2026 is on the expansion of FSD into China and Europe. If Tesla can navigate the regulatory hurdles and prove that their vision-only system works better than the LiDAR-heavy systems used by Chinese rivals like XPeng and Li Auto, they will regain their tech edge. This is the ultimate expectation versus reality battleground. The bulls expect a world where millions of Teslas act as a distributed compute network, earning revenue while their owners sleep. The reality, as it stands in January 2026, is a suite of advanced driver assistance features that still require human supervision and face intense regulatory pushback in key markets. If you are managing your own Fidelity IRAs or Robinhood cash management accounts, the risk is that the timeline for this transition is much longer than the market is willing to wait. There is also the macroeconomic reality to consider. Higher interest rates have historically been a headwind for big-ticket purchases like cars. While the Fed has hinted at a more accommodative stance, the higher-for-longer environment of late 2025 has made monthly payments a real pain point for the average consumer. Tesla has tried to combat this with zero-interest financing in China and massive price cuts in North America. These are great for consumers and for keeping delivery numbers from falling off a cliff, but they are devastating for the profit and loss statement. When you use inline invest platforms or SoFi stocks tools, you have to look at the earnings quality. Are these profits sustainable? Are they coming from core operations or from one-time regulatory credits? In 2025, regulatory credits were a significant cushion, but they are a dwindling resource as other automakers ramp up their own EV production and no longer need to buy credits from Tesla. For those looking at online investing or using a SoFi robo-advisor, the diversification of Tesla's revenue is the primary bull case. The energy business is growing at a much faster clip than the automotive business, and it carries potentially higher long-term margins. However, it still only represents a fraction of total revenue. To truly justify the current market cap, the energy and AI segments don't just need to grow, they need to explode. We are talking about a scenario where the energy business becomes as large as the auto business was in 2022. That is a tall order, but it's the one the market is currently betting on. If you are trading Nvidia stock or Apple stock alongside Tesla, you'll notice that these companies have much cleaner earnings profiles. Tesla is the outlier, a company with lumpy growth and a CEO who is as much a political figure as a corporate leader. This volatility is a feature, not a bug for those who use Robinhood fractional shares to trade the swings, but it's a significant risk for those seeking stability in their Fidelity brokerage accounts. The upcoming months will be a defining period for the company. We have the Q4 earnings call, which will set the tone for the entire year. We have the potential of new model announcements, perhaps a Model 2 or a more affordable platform that can compete with the $20,000 offerings from China. And we have the ongoing saga of FSD development. If the reality of these catalysts meets the high expectations of the market, Tesla could easily see a run back towards its all-time highs near $450. If the reality falls short, if margins continue to bleed, and the